Michael Burry is famous for making some really accurate stock market guesses that have caught the attention of both finance experts and regular people. But it makes you wonder, how often is he right, or do we forget the times he's wrong because of his few big correct calls? We've been tracking every prediction Michael Burry has made on Twitter for the last few years to find out. This includes one forecast that's already coming true and looks to be set proven by mid-2024. On June the 13th, 2022, Burry compared the stock market to a scenario where it takes a long time to fill a theatre, but everyone tries to leave at once when there's panic, suggesting a slow market crash that unfolds over several years. When Burry made his prediction, inflation in the US was around 9% and the Federal Reserve had started to raise the federal funds interest rate from 0.1% to 1.2%. The stock market had also dropped about 15% in 6 months. His tweet seemed to suggest that the market's downturn would continue for a while. However, after his June 2022 tweet, the market did fall another 8%, but then rebounded by 29%, ending up about 18% higher than when he predicted. This shows that while the market initially followed his grim outlook, it bounced back stronger than expected. Yet, it's worth noting that 18 months might not be long enough to fully judge his prediction's accuracy, but we'll discuss this more later. But on the same day as his market prediction, Burry also reflected on his past predictions, listing successful calls like the tech bubble in 1999, the value revival from 2001 to 2005, the housing bubble in 2005, investing in almond farms in 2009, calling the bottom of the coronavirus market in 2020, predicting the impact of lockdowns, the rise of meme stocks, and the use of leverage in crypto in 2021, and inflation in 2022. He hinted that he wasn't done predicting, leaving us wondering what was next. Another example is how he managed during the 1999 tech bubble and the subsequent rise of value stocks after the 2000 crash. In an investor letter, Burry explained that he didn't foresee the exact moment the tech bubble would burst. Instead, his stock-picking strategy helped shield his investments from the crash. He highlighted that the key achievement of his fund wasn't just the 8.24% gain in 2 months, but more importantly, avoiding the significant losses that hit the indices and many popular stocks at the time. Even though his fund was only active for the last 2 months of 2000, it outperformed the Nasdaq significantly, which dropped by 22.9%. Burry also shifted his focus to buying small-cap value stocks in 2001, anticipating that the after-effects of the internet bubble bursting would lead to a downturn in larger companies as well. His prediction was accurate, as the market experienced a 2-year bear market that saw a decline of over 40%, ending only in 2002. Burry's track record consists mainly of significant financial events, and his comments toward the end of 2022 suggested he was expecting another major occurrence. While the broader market didn't face a dramatic event as perhaps anticipated, the financial world did witness a huge incident with the collapse of FTX and the arrest of Sam Bankman-Fried, leading to one of the largest financial fraud cases in history. This suggests that while not all of Burry's predictions may come to pass as expected in the broader market, his insights often align with significant financial developments. Looking back at all the things Michael Burry said on Twitter in June 2022, it wouldn't be quite fair to say he predicted the collapse of a specific financial event. But let's move on to another of his forecasts. Don't forget to like, share, and subscribe for more great content. A bit after his initial tweets, he mentioned that when you adjust for inflation, the first half of 2022 saw the S&P 500 drop by 25 to 26%, the Nasdaq by 34 to 35%, and Bitcoin by 64 to 65%. He called this multiple compression and hinted that earnings compression might be next, suggesting we were only halfway through the process. To understand how stock or market prices are determined, you can look at 2 main things: how much money the companies make, earnings, and how much people are willing to pay for those earnings multiple. For example, in June 2021, the S&P 500 companies made about $159 per share, and the price-to-earnings ratio was 27. This means the market valued the S&P 500 at about 4,293 points. It's crucial to know this because the stock market can still drop even if companies make the same amount of money or more, especially if the amount people are willing to pay for those earnings goes down. One big thing that can cause these earnings multiples to shrink is rising interest rates, which is exactly what happened from mid-2021 to mid-2022. The Federal Reserve raised rates to fight inflation, leading to lower multiples even as company profits grew by an impressive 21%. The price-to-earnings P/E ratio of the market dropped from 27 to 20, leading to a 12% decrease in the market. This drop is what Michael Burry was talking about when he mentioned multiple compression. He then warned of earnings compression, suggesting we were only partway through the process. His prediction was that company earnings would significantly decrease, and he was correct. S&P earnings went down from $192 to $181 per share, a 6% fall. Despite the drop in earnings, the stock market actually went up. This happened because the earnings multiple, which had shrunk from 27 to 20, rose again to nearly 26. If the multiple had stayed at 20, the market would have fallen by 4.5% since Burry's prediction, instead of rising. To summarize, the S&P 500's earnings multiples shrank, and Burry accurately predicted a decrease in corporate earnings. However, he didn't predict the stock market's overall direction correctly because the earnings multiple increased again. But it's possible that this increase in the earnings multiple might be temporary. If it decreases again, Burry's prediction could still turn out to be accurate. In an August 2022 tweet, Burry reflected on a historical event, hinting at a bigger picture. He talked about a critical error by the Federal Reserve during the 1970s inflation crisis, suggesting a parallel with current times. This implies that Burry believes current market conditions might not sustain and could reflect past mistakes, indicating a cautious outlook for the future. The Federal Reserve once made the error of lowering interest rates too soon, which initially boosted the stock market but eventually caused a second spike in inflation, necessitating further rate hikes and leading to a prolonged period of stock market decline. Currently, we're seeing a situation that closely mirrors this. After a significant inflation increase, the Federal Reserve increased interest rates and the stock market took a hit. However, with inflation now subsiding toward normal levels, the market anticipates rate cuts in 2024. This expectation is evident from the fact that the one-year government bond rate is lower than the one-month rate, suggesting lower interest rates in a year. This anticipation has also contributed to the recent expansion of the earnings multiple. Michael Burry's 2022 forecasts can be viewed as a single overreaching prediction. We're in a temporary stock market rise that could sour if inflation spikes again. While Burry's predictions have been somewhat accurate, the full realization of his forecasts remains to be seen. In early 2023, Burry hinted at this continuing pattern with a market analysis reminiscent of the 2000 to 2003 period, showing an initial 31% market drop in 2000, followed by a 10% rebound lasting 6 months before a further 29% decline over the next 6 months. This analogy suggests Burry expects a temporary market recovery, followed by a more significant downturn, reinforcing his cautious outlook on the market's future. At the start of 2023, the market was recovering after a significant drop throughout most of 2022. Michael Burry speculated there might be a further decline in 2023 and acted on this by betting against the S&P 500 and Nasdaq sometime in the second quarter of 2023. The details of this bet are unknown, but it seems he wagered on a significant market drop, albeit possibly with a small investment. Whether this bet was profitable is unclear, as the stock market didn't fall as he anticipated. Instead, it rose by 21%, marking one of its best years, especially for tech stocks. Burry also predicted that inflation had reached its peak, but warned of another spike within the cycle. He expected the Consumer Price Index, CPI, to drop, possibly into negative territory in the latter half of 2023, and predicted a recession by any standard, followed by federal rate cuts and government stimulus, leading to another inflation spike. However, these predictions didn't pan out as expected. The CPI didn't go negative and the US was far from a recession, with the GDP growing at an impressive annualized rate of 5.2% after adjusting for inflation. While Burry has been correct on many of his public predictions, his inaccuracies often stem from assigning specific timelines to economic events, a task that's notoriously hard to nail down. Despite the occasional miss, Burry's insights into the economy and the market mechanics are highly valued because of his thorough research and understanding. However, the difficulty in precisely timing economic predictions serves as a reminder why many investors prefer strategies that can weather various economic conditions without banking on the prediction of recessions or inflation surges. This approach focuses on selecting investments that can endure through economic fluctuations rather than relying on the accurate forecasting of economic events. So, what do you think about Burry's predictions? Let us know in the comments. Click here to watch other great videos and don't forget to like, share and subscribe to our channel for more fascinating videos.